Hi everyone, I'm Monty, the CEO and founder of Valur. In this video, we'll talk about the three types of charitable remainder unit trust: the Standard CRUT, the NIMCRUT, and the Flip CRUT. We'll explore what are their key differences and common use cases for each. If you still haven't watched any of our previous videos on these topics, I strongly encourage you to do so. You can also use our linked customizable calculator to get a glimpse of the potential financial gains from each of these types of charitable remainder unit trusts and how they differ. Or if you want to dive deeper, you can schedule a call and chat with one of our trust experts if you have any questions. So let's get started. The first thing you should know is that all three of these structures have many features in common with each other. First and most importantly, they're all tax-exempt structures. This means that neither you nor the trust will have to pay federal or state taxes on the gains as long as the money stays inside the trust. You'll only pay taxes when you receive distributions from the trust to yourself, very similar to an IRA. Second, they're all irrevocable trusts, which means they can't be modified after they are created. And third, each can last for a defined period of years, up to 20 years, or for the lifetimes of a single or multiple beneficiaries. Now, on the subject of beneficiaries, for each of these trusts, you aren't the only beneficiary. There's always an income beneficiary, typically you or family members, who receive at least annual payments from the trust during its term, or however long it lasts, and a remainder beneficiary, that is a charitable entity that receives whatever is left in the trust after the trust ends. Now, the primary difference between Standard CRUTs, NIMCRUTs, and Flip CRUTs is how and when you receive distributions or payout from the trust. With a Standard CRUT, you will receive a payout that is a set percentage of trust assets every year. That percentage is determined at the start of the trust and is based on its expected length, and it doesn't change during the trust term. You'll receive those payouts that are a set percentage of the trust assets value no matter what. On the other hand, with the NIMCRUT, you are still entitled to that same annual percentage of trust assets outlined in a Standard CRUT. However, you'll only receive the lower of the trust income from that year or that set percentage of trust assets. In other words, if the trust doesn't have enough income to pay out that fixed percentage of trust assets, you'll only receive whatever income the trust did generate. Now, critically, any amount that you're underpaid in a given year can be paid out in future years if there is enough income generated in the trust. Essentially, if you're underpaid, that amount accrues and you can get it distributed later on. Now, finally, a Flip CRUT is a hybrid of the two approaches. It starts as a NIMCRUT and flips to a Standard CRUT after a predetermined triggering event, such as the sale of an illiquid asset or a specific number of years. Now, after that flip happens, you'll start receiving a set percentage of trust assets, just as you would in a Standard CRUT. You're probably wondering, when is each type of trust a good idea? Because Standard CRUTs pay out a steady share of trust assets every year, they tend to have slightly lower returns than NIMCRUTs. This is because the Standard CRUT is forced to give you annual distributions, which means your money and assets can't stay in the trust for as long as they can in a NIMCRUT and have less time to go tax-free. Now, on the other hand, because a Standard CRUT distributions don't depend on a trust realizing income, people often choose it if they value consistent distributions over potentially higher but uncertain distributions. Now imagine if you don't need distributions every single year. With a NIMCRUT, you can defer your payout by choosing not to realize any income inside the trust. You can withdraw the assets from the trust when you're ready by selling assets and realizing income, because a NIMCRUT is constrained by the income realized in any given year. In the meantime, it allows your assets to stay inside the trust and grow tax-free for a longer period of time, creating more value for yourself. As a result, a lifetime NIMCRUT might see as much as 30 to 50% greater payouts than a Standard CRUT. Finally, a Flip CRUT is often used when the beneficiaries want the benefits of a Standard CRUT, i.e. the predictability of payouts, but don't need those distributions right away. Say they're waiting for retirement or the sale of a business. In conclusion, although everyone's preferences and circumstances are different, Standard CRUTs can be a good fit for people who are willing to give up potentially higher returns in exchange for relatively predictable and consistent payouts. NIMCRUTs, on the other hand, typically maximize the total returns over a long charitable remainder unit trust and are for people who don't need consistent distributions every year. And Flip CRUTs generally work best for people who have illiquid assets that they won't be able to liquidate for a while, or when someone values predictable distributions after a set event or certain period of time. Now, a quick word about Valur. We've built a platform to give everyone access to the tax planning tools of billionaires like Facebook founder Mark Zuckerberg and others. We make it simple and seamless to pick the best strategy, set up and administer these structures at a fraction of the cost of competitors. I really hope you found this video useful. If you still have any questions, please visit our website at Valur, valur.io, where you can read more content on these subjects, play with our online calculator to discover your potential financial gains, or schedule a call with us.